All right, let's get right into it. We're going to talk about one of the biggest, fastest growing, and honestly most important parts of the financial system that you might have never even heard of, private credit. It's a huge story about even bigger money and some pretty well-hidden risks.
Just to give you a sense of the scale we're dealing with here, the global private credit market is now worth around $2 trillion. Yep, that's trillion with a T. It has become this absolutely massive pillar of global finance, funding thousands and thousands of companies.
And here's the thing. This entire $2 trillion market operates, for the most part, in the shadows. We're talking about loans that are negotiated privately, one-on-one between companies and investment funds. You won't see them on public stock exchanges, and they operate largely outside of the typical banking regulations.
So, this brings us to the big question, the one we're going to try and unpack in this explainer. Is this innovation the future of how businesses get money to grow? Or, by operating in the shadows, is it quietly planting the seeds for the next big financial crisis?
To even begin to answer that, we first have to get on the same page. What exactly is private credit?
So, put simply, private credit is just when an investment fund, so not a bank, lends money directly to a company. You can think of it like a regular corporate loan, but instead of going to a big, familiar bank, a business goes to a specialized asset manager. The whole process basically cuts out the middleman and operates outside that conventional banking system.
And this alternative way of lending hasn't just been growing, it has absolutely exploded. Let's take a look at the numbers.
This chart from the Federal Reserve really tells the story, at least in the US. Just look at that dark blue line. Back in the year 2000, the market was only about $46 billion. By 2023, roughly $1 trillion. But look closely at the timing. See how the growth really takes off right after the 2008 financial crisis? Well, that is no coincidence.
So what happened? Well, this boom was really fueled by two incredibly powerful forces hitting at the exact same time. First, after the '08 crisis, new regulations made it way harder and more expensive for traditional banks to make certain types of corporate loans, so they backed off. At the same time, you had huge investors, think pension funds, insurance companies who were desperate for better returns in a world of super low interest rates. Private credit offered them exactly that, with yields often promising a pretty juicy 8 to 14%. So the banks stepped out, and these big investors stepped right in. Now, this sets up what looks like a simple competition, right? You've got the new private lenders on one side and the old traditional banks on the other. But the real relationship, well, it's way more complicated and, frankly, a lot more interesting than that.
On the surface, yeah, they look like direct competitors. The private credit funds are faster, they're way more flexible, and they can really tailor a loan to exactly what a borrower needs. Banks, on the other hand, are slower, more standardized, and, of course, heavily regulated. But that speed and flexibility, it comes at a price. It's usually more expensive for the companies borrowing the money.
This all seems like a pretty straightforward David versus Goliath story, doesn't it? These nimble new players are just taking market share from the old guard. But wait a minute. This raises a really important question. Where are these private credit funds getting their own money to lend out in the first place?
And here is the big twist. The answer is the banks. That's right, traditional banks are one of the main sources of funding for their biggest competitors. And this chart brilliantly shows how they do it while keeping themselves safe. Federal Reserve data shows that when banks lend to these private credit operations, a whopping 97% of that money is first lien senior. Now, in simple terms, that just means the bank is always first in line to get paid back, no matter what happens.
In fact, the Federal Reserve compares this whole structure to a securitization. Let's break it down. So imagine a private credit fund's stack of money. At the very bottom, you've got the fund's own cash, the shareholder equity. This is the first slice of money to get wiped out if loans go bad. It's the highest risk. And at the very top, you have the loans from the banks. They have the lowest risk because they have to be paid back before anyone else even sees a dime. So you see, the banks aren't really competing, they're just taking the safest, top-rated piece of a business they supposedly got out of.
This cozy, interconnected relationship might look really smart for the banks, but it also creates a whole new set of hidden risks for the entire financial system. So let's take a closer look at what's hiding in the shadows.
This quote from an expert at the IMF, I think, just captures the core problem perfectly. For all of its massive growth, this $2 trillion market has grown up almost entirely during a time of low interest rates and a pretty stable economy. It has never, ever been tested by a real storm. And regulators are starting to notice several of these shadow risks popping up. First, valuation. Since these loans don't trade on a market, how do we know what they're actually worth? Well, the fund managers tell us what they're worth. Second, there's a liquidity mismatch. Some of these funds promise their investors they can get their cash out quickly, but the loans themselves are locked up for years. What happens if everyone runs for the exit at once? Third is something called payment in kind interest. So imagine a company is struggling and can't make its interest payment in cash. No problem. They just add the amount they owe to the total loan balance. So the loan gets bigger, the lender's books look perfectly fine, but no actual money has changed hands. It can hide just how much trouble a borrower is really in. And finally, spillover risk. If this market hits a rough patch, the stress could easily spill right over into the traditional banking system through those very same credit lines that the banks thought were so safe.
So all of this brings us right back to where we started, just trying to make sense of this new financial world we're in.
What we're left with is this incredible duality. On the one hand, private credit is filling a really important gap. It's providing essential funding for thousands of companies that banks just don't serve anymore. It's become a real engine for growth. But on the other hand, it has created this deeply interconnected, tangled web with the very banking system it was supposed to replace. And that has created all these new pathways for risk that we just don't fully understand yet.
And that leaves us with the final $2 trillion question. The system has been redesigned. You could say the very plumbing of global finance has been rerouted through all these private channels, but it's never been stress tested. So, what happens when this untested $2 trillion market faces its first real storm?